On January 15, 2026, Brian Moynihan, CEO of Bank of America, said something that should have dominated every financial headline in the country. He told a room full of institutional investors that $6 trillion could leave the United States banking system within 36 months. $6 trillion. That's not a projection. That's his baseline estimate. $6 trillion represents roughly 30% of all commercial bank deposits in America. Gone. Not to other banks, not to foreign institutions, to something that didn't exist as a serious threat 5 years ago. Stablecoins. And the reason Moynihan is warning the industry, the reason every major bank CEO is quietly restructuring their deposit strategies, traces back to exactly 2 years earlier, January 10th, 2024. The Securities and Exchange Commission approved 11 spot Bitcoin exchange-traded funds. The largest of those funds, BlackRock's iShares Bitcoin Trust, just crossed $70 billion in assets. $70 billion in 2 years. That's the fastest growth to that scale in ETF history. Faster than gold trusts, faster than any equity fund, faster than anything Wall Street has ever seen. But the $70 billion isn't the real story. The $70 billion is the proof of concept. Because what BlackRock demonstrated is that institutional money, the pension funds and endowments and wealth managers who control tens of trillions in assets, they want crypto exposure. And once they have that exposure, once they see how the infrastructure works, once they understand that digital assets can deliver yields and liquidity that traditional banking can't match, the next question becomes obvious. Why keep $6 trillion sitting in bank accounts earning 0.1% when you can hold stablecoins backed by Treasury bonds earning 4 to 5%? The answer is you don't. And that's the $6 trillion exodus that's about to reshape American finance. This isn't theory. This isn't speculation. This is mathematical inevitability, and it's happening right now. I'm Marcus Caldwell, and for the past 2 years I've been tracking institutional movements into digital assets that mainstream financial media consistently ignores or misunderstands. What I'm about to show you is how BlackRock's $70 billion Bitcoin ETF created the foundation for the largest deposit migration in banking history. Let me take you back to January 10th, 2024, the day everything changed for institutional crypto adoption. The SEC had been fighting Bitcoin ETF applications for over a decade. Multiple rejections, endless delays. The official reason was always investor protection. The real reason was regulatory resistance to legitimizing an asset class that threatened traditional finance. But in June 2023, BlackRock filed an application. And BlackRock doesn't file applications it expects to lose. BlackRock is the largest asset manager in the world, $10 trillion under management. More assets than the gross domestic product of every country except the United States and China. When BlackRock files, regulators listen. When BlackRock wants something, BlackRock usually gets it. The application was different from previous attempts. It had robust custody solutions through Coinbase. It had surveillance sharing agreements with regulators. It had institutional-grade risk management protocols. And most importantly, it had BlackRock's reputation behind it. On January 10, 2024, the SEC approved 11 spot Bitcoin ETFs simultaneously. But everyone knew the one that mattered was BlackRock's iShares Bitcoin Trust, ticker symbol IBIT. First day of trading, IBIT processed $627 million in volume. By end of first week, $1 billion in assets. By end of first month, $10 billion. By end of first year, $55 billion. As of January 22, 2026, IBIT holds $70 billion in Bitcoin. That makes it the 19th largest ETF in the United States by assets, ahead of funds that have existed for 20 years. A 2-year-old Bitcoin fund is in the top 20 out of thousands of ETFs. Before I show you what this means for the banking system, if this intelligence is valuable, hit that subscribe button and turn on notifications. This channel exists to give you market insights institutions don't want retail investors to have. Your subscription directly supports independent financial analysis, free from Wall Street spin. Now let's examine what happens when $70 billion in institutional capital proves crypto demand is real, but the assets under management don't tell the full story. Look at who's buying. According to public SEC filings, over 700 institutional investors now hold IBIT. State pension funds, university endowments, insurance companies, wealth management firms, corporate treasury departments. These aren't retail speculators. These are fiduciaries managing retirement money. Wisconsin State Pension Fund holds $29 million in IBIT. Michigan State Pension, $95 million. Arizona Public Safety Personnel Retirement System, $19 million. These are conservative institutions with strict fiduciary mandates, putting police officer pensions and teacher retirement funds into Bitcoin. Why? Because asset allocation models changed fundamentally after 15 years of zero interest rate policy. For decades, the standard portfolio was 60% stocks, 40% bonds. That worked when bonds paid 6 to 8% annually. But after 15 years of near-zero rates following 2008, bonds barely outpaced inflation. A 10-year Treasury yielding 2% when inflation runs at 3% means you're losing purchasing power. The 60-40 portfolio became obsolete. So institutional investors started looking for alternatives. And increasingly, they looked at Bitcoin not as speculation, but as a portfolio diversifier with low correlation to traditional assets. From 2013 to 2023, Bitcoin's correlation to the S&P 500 was near zero. That's exactly what you want from a portfolio diversifier. But institutional investors couldn't buy Bitcoin directly. Regulatory constraints prevented most pension funds from holding crypto on balance sheets. Custody concerns made boards nervous. They needed a regulated vehicle, an ETF, something they could buy through existing brokerage accounts with familiar custody and settlement. And once BlackRock provided that vehicle, once they removed the friction, the floodgates opened. In the first week of January 2026, IBIT saw $888.6 million in net inflows. 1 week. That's institutional money coming in after New Year portfolio rebalancing. At the same time, traditional banking deposits were declining. According to Federal Reserve data, commercial bank deposits fell by $212 billion in the fourth quarter of 2025. $212 billion. Where did that money go? Some went to money market funds chasing higher yields. Some went to Treasury bills directly. And an increasing amount went to stablecoins. And that's where the real threat to banking begins. Most people don't understand how banking works at a fundamental level. They think banks are safe deposit boxes. That's not remotely how it works. Banks operate on fractional reserve lending. When you deposit $1,000, the bank keeps only 10% in reserve. The other $900 gets lent out immediately to someone buying a house, to a business expanding operations, to someone financing a car. The bank earns interest on those loans, 4 to 8% on mortgages, 6 to 12% on business loans. That's how they make money. The system works because not everyone withdraws deposits simultaneously. But what happens if that assumption breaks? What happens if 10 or 20% of depositors want their money at once? We saw this in March 2023 with Silicon Valley Bank. SVB held approximately $200 billion in deposits. Those deposits were invested in long-term Treasury bonds purchased when rates were near zero. Then the Federal Reserve raised rates aggressively from 0 to 5% in 18 months. Bond values crashed. SVB was sitting on over $15 billion in paper losses. When depositors got nervous and started withdrawing money, SVB had to sell bonds to raise cash at huge losses. Within 48 hours, Silicon Valley Bank went from solvent to bankrupt. $142 billion in withdrawal requests in a single day. The bank couldn't meet them. It failed. The 16th largest bank in America collapsed in 2 days. That was one bank. Now imagine that dynamic playing out across the entire banking system. Not because of crisis, not because of panic, but because of yield competition. Because customers realized they could earn dramatically higher returns elsewhere. Depositors don't all move at once, but over months, the flow is steady and relentless. 3% of deposits in month 1, 5% in month 2, 7% in month 3. The numbers compound. The exodus accelerates. Banks start losing the cheapest source of funding they have, customer deposits. They have to replace that funding with more expensive wholesale borrowing. Their net interest margins compress. Profitability falls. Stock prices decline. Credit ratings get downgraded. A doom loop. And here's the killer detail most people miss. The loans banks made don't disappear when deposits leave. If a bank lent $900 billion secured by customer deposits and those deposits leave, the bank still has $900 billion in loans on the books. Those loans mature over years or decades. But the deposits funding that mortgage can leave in minutes. The only way to replace deposits quickly is to borrow from other banks or from the Federal Reserve discount window. But that borrowing is expensive. And if multiple banks are competing for the same wholesale funding simultaneously, because they're all losing deposits to stablecoins, rates spike dramatically. This is a liquidity crisis, not a solvency crisis. The banks aren't insolvent. They have assets, good assets. But those assets are illiquid. They can't be sold quickly without taking massive losses. We've seen this movie before. 2008. Lehman Brothers, Bear Stearns, Washington Mutual, Wachovia. Banks with hundreds of billions in assets that collapsed in days because they couldn't fund themselves when confidence evaporated. The difference between 2008 and what's coming is the trigger. In 2008, the crisis was triggered by bad assets, subprime mortgages defaulting, asset quality deterioration. This time, the assets are fine. United States government Treasury bills, prime residential mortgages, investment-grade corporate bonds. The asset quality is not the problem. The problem is deposit flight driven by yield competition. And the trigger isn't crisis, it's innovation. Better products, higher yields, more convenience. Stablecoins are simply better than bank deposits for many use cases. Objectively better. And once that becomes widely understood, once the infrastructure makes them accessible to mainstream users, the shift accelerates exponentially. Banks understand this completely. That's why they're fighting regulatory approval of yield-bearing stablecoins. That's why banking industry lobby groups are pushing Congress to slow down crypto adoption. That's why Brian Moynihan is publicly warning about $6 trillion in potential outflows. He's not fear-mongering. He's stating mathematical reality based on yield differentials, but the momentum is already too strong. BlackRock's $70 billion Bitcoin ETF proved institutional demand exists. And once both are legitimized, once mainstream financial institutions are offering these products through familiar channels, the deposit flight begins in earnest. Not as crisis, as rational consumer choice. Now let me show you what BlackRock is actually building, because the Bitcoin ETF isn't the endgame. It's phase one of a multi-phase strategy. Larry Fink, BlackRock's CEO, has been remarkably public about his views on crypto since 2023. He called Bitcoin digital gold in multiple interviews. He said blockchain technology would fundamentally transform financial markets over the next decade. These weren't offhand comments. These were strategic signals. Tokenization means taking real-world assets like stocks, bonds, real estate, commodities, and representing ownership through digital tokens on a blockchain. Why does tokenization matter? 3 reasons: speed, cost, and accessibility. Traditional security settlement takes 2 business days. With tokenized assets, settlement is instant. Seconds. Traditional securities have high transaction costs. Tokenized assets eliminate most intermediaries. Fees drop from dollars per transaction to pennies or less. Traditional securities have restricted access based on wealth and geography. Tokenized assets can be fractionalized. Own 1/10 of a commercial property. Own 0.01 Bitcoin. Democratized access. BlackRock launched the BlackRock USD Institutional Digital Liquidity Fund in March 2024. It's a tokenized money market fund built on Ethereum blockchain. The fund yields approximately 5% annually and settles instantly. As of January 2026, it holds over $700 million in assets. Now connect all the dots. BlackRock operates the largest Bitcoin ETF at $70 billion. They have tokenized money market funds operating on blockchain. They have relationships with every major institutional investor in the world. And according to multiple industry sources, they're applying for federal stablecoin licenses. Imagine a BlackRock-issued stablecoin launching in late 2026, fully backed by United States Treasury bills, yielding 4.5%, available through every broker that already distributes BlackRock funds, which is basically everyone. Institutions trust BlackRock more than they trust any crypto-native company. If BlackRock offers a stablecoin with institutional-grade custody, regulatory compliance, and competitive yield, adoption will be massive and rapid. That's the master plan. Bitcoin ETF proves crypto demand. Tokenized funds prove blockchain infrastructure works. Stablecoin provides the on-ramp for trillions to enter the digital ecosystem. And once dollars are in that ecosystem earning yield, they don't flow back to traditional banks. This is why BlackRock's $70 billion matters so profoundly. Not because $70 billion is transformative by itself, but because it's the proof of concept that unlocks everything else. So what does all this mean for you? First, if you have money in traditional bank accounts earning near zero interest, you're losing significant purchasing power. With inflation at 3 to 4%, your $100,000 becomes $96,000 in real value after 1 year. Once yield-bearing stablecoins become available through mainstream brokerages in Q1 2026, moving a portion makes mathematical sense. The risk profile is nearly identical to bank deposits. Stablecoins issued under federal charters are backed by Treasury bills. Treasury bills are backed by the full faith and credit of the U.S. government, same backing that protects your bank deposits through FDIC insurance. The risk is equivalent. The yield is 40 to 50 times higher. Second, if you work in traditional banking, understand the structural shift happening. Banks will need fewer physical branches. But digital asset custody, blockchain infrastructure, stablecoin distribution, these are growth areas. Third, if you're an investor, the companies building infrastructure for this transition will capture enormous value. BlackRock, Coinbase, Circle, Fidelity, picks and shovels companies of the digital asset gold rush. Fourth, if you're a business owner with significant cash holdings, corporate treasury management is being revolutionized right now. Companies adopting stablecoin treasury strategies early will have meaningful competitive advantages. Here's specifically what you should do. Start small. Allocate 1 to 5% of your portfolio to Bitcoin through ETFs, like BlackRock's IBIT. Not because Bitcoin will definitely go up, but because portfolio theory suggests holding uncorrelated assets improves risk-adjusted returns. When yield-bearing stablecoins become available in Q1 2026, test them. Move a small amount. Understand how they work. Build confidence before committing larger amounts. Don't overallocate to any single innovation. This isn't about speculation. This is about adapting to structural change the same way you adapted from cash to debit cards, from paper checks to online banking. Evolution, not revolution. Stay informed about regulatory developments. Follow primary sources. Read actual SEC filings, not just headlines. And ignore the extreme voices on both sides. The truth is in the middle. Some applications will succeed massively. Some will fail completely. Your job is to understand which is which through careful analysis. Let me connect all the pieces. On January 15, 2026, Brian Moynihan warned that $6 trillion could leave banking over 3 years. On January 22, 2026, BlackRock's Bitcoin ETF held $70 billion exactly 2 years after launch. These aren't separate stories. They're deeply connected parts of the same transformation. BlackRock's success proved institutional demand for crypto is real, massive, and growing. That proof of concept opened regulatory doors for everything that follows. Stablecoins, tokenized assets, blockchain infrastructure, yield-bearing digital dollars. Once that infrastructure is operational, once stablecoins are available through every major brokerage with regulatory protections, the $6 trillion deposit exodus moves from theoretical to mathematical certainty. Not because banks are bad, because innovation provided objectively better alternatives. Higher yields, lower fees, instant settlement, better products win. Markets decide. This is the biggest transformation in finance since online banking in the 1990s, possibly bigger. Because online banking changed the interface. Blockchain changes the actual infrastructure, the foundation. Banks that resist will slowly shrink. Banks that adapt will survive and potentially thrive. Companies building new infrastructure will capture enormous value as trillions migrate to digital rails. And individuals who understand this shift early, who position appropriately, who build skills in emerging infrastructure, they will have significant advantages. BlackRock's $70 billion Bitcoin ETF didn't trigger banking panic, but it proved the concept that made everything else possible. It legitimized institutional crypto adoption. It demonstrated trillions in institutional capital wanted digital asset exposure, if given the right vehicles. And that legitimization enabled the stablecoin revolution, the tokenization wave, the $6 trillion deposit migration. It's all connected, all part of the same transformation. And it started with one ETF 2 years ago that most people dismissed. If this analysis has been valuable, subscribe immediately. The next 90 days will be critical. Circle's March YPO, Fidelity's March stablecoin launch, BlackRock's stablecoin charter approval. Multiple catalysts converging in Q1 2026. The $70 billion proof of concept is complete. The $6 trillion migration is beginning. And Wall Street's biggest structural shift since 2008 is happening right now. The question isn't whether this happens. The question is whether you understand it early enough to position accordingly. Thanks for watching The Equity Edge. I'll see you in the next one.